India has been on a path of macroeconomic momentum, greater stability for the last few years, and this budget should be looked at in that context. So, the last few years, we have seen our current account dynamics getting more and more positive. We have seen both RBI as well as the government playing a very important and proactive role in managing inflation. And we have seen over the pandemic, the fiscal stance of the government has been very responsible. The budget today takes forward this macroeconomic momentum by putting on the table a very considerable fiscal consolidation for FY25, and it takes it forward for FY26 as well. So, between budget estimates of FY24 and FY25, the finance minister has put on the table an 80 basis point consolidation in fiscal deficit. And for FY26, another 60 basis point is very much in the offing. What this does is this provides much greater macroeconomic stability and significantly improves perception of India financial assets as far as both local as well as global investors are concerned. From a fixed income market standpoint, the market has cheered a lower than expected gross market borrowing, which is in line with the deficit number itself being lower than what many market participants were projecting. But we think there is a much greater point about the way India's bond market is generally developing. India is growing in size. It's a very, very large market now to contend with for global investors. And like I said, macroeconomically, India has been showing great improvements towards which this budget makes a significant further contribution. You will note that India is also scheduled to start getting included in a major global bond index this year. And we think this, along with the great strides India is taking on macroeconomic stability, will ensure that over the next few years, you will see much greater interest from global investors as far as India bonds are concerned. In the very near term, we think this amount of fiscal consolidation and the commitment to macroeconomic stability that the government has shown will enable the RBI to also progressively begin to relax their stance as far as monetary policy is concerned. We think probably by the April 2024 monetary policy, the RBI would shift their stance towards neutral, post which over the course of the next 1.5 years, we would expect RBI to cut repo rates by between 50 to 75 basis points. However, we think the scope for bond market performance may actually be higher because India still enjoys positive term spreads, which means that most bonds are trading much higher than where the overnight repo rate is at. And we think there is great scope for this term spread to compress as well as we go ahead. We think, over the last 2 years, investors have been running very conservative duration and been focusing on carry. And that mindset now needs to be flipped. The focus has to be more on quality bonds now. And investors probably now need to start to think about reinvestment risks on maturing investments going forward. For that reason, it may be advisable or prudent to start to add some duration to portfolios. That's pretty much, what we think makes sense if you take the next 2 to 3 years into consideration. So in summary, we think the budget continues the path of macroeconomic momentum that India is witnessing. We think with greater international interest for Indian bonds over the course of the next 2 to 3 years, bonds are probably poised for reasonably decent performance. At the same time, risk management has to be up and front for investors. So investors need to match investment horizon with the risk taken by products. We always think about mutual fund products under core and satellite buckets. So for more moderate risk investors, more moderate duration products may be more suitable. And investors who have longer term investment horizons can potentially also look at active duration or longer duration products.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.